Welcome. We are following this book. Today's lecture on complete all steps in accounting cycle. Complete all steps in accounting cycles. On this topic, just we will set up an example, mathematical example. Okay. So first on analyze business transactions. Second on journalize transactions. That means all steps. Here we have 9 steps. 1, 2, 3, 4, 5, 6, 7, 8, 9 steps. First one, analyze business transactions. So here, transactions. Now, we would like to discuss on transactions or business transactions are a business economic events recorded by accountants. Okay. So here I make you clear, companies carry on many activities that do not represent business transactions. That means all activities do not represent business transactions. Number one. Number second, examples are hiring employees, responding to emails, talking with customers, and placing merchandise orders. This is not transactions. The company must analyze each event to find out if it affects the components of the accounting transactions. Must analyze. Company must analyze whether registered transactions or not. And if it does, the company will record the transaction. That means if the company found that it's a transaction, then they will record the transaction. Last one, illustration demonstrates the transaction identification process. We could proceed next. Transaction illustration. Are the following events recorded in the accounting records? Events. Purchase computer. I think purchase computer must be a transaction. Yes. Record. And discuss product design with potential customers. It must not be transactions. So no, it's not a transaction. Parent, it's a transaction. Yes. So this is our first point. That means complete all steps in accounting cycle. The accounting cycle, first one, analyze business transactions. Already we have discussed on it. Now complete all steps in accounting cycle. All steps. Anna Clark opened Anna's cleaning service on July 1, 2017. During July, the following transactions were completed. Here we have a lot of transactions. So first one, according to questions, journalize and post July transactions. This will be our first point. First instructions. First instruction, analyze and post the July transactions. And here this is the chart of accounts. Chart of accounts, number 010 cash, 1 and 2 account receivable, and so on. And number B, prepare trial balance. Number C, we have some adjustment entries. Number D, income statements, owner's equity estimates, and classified balance sheet. Number E, journalize and post adjusting entries. And number F, journalize and post closing entries and computed the closing process and prepare post closing trial balance. We have a lot of instructions here. The first one, we will complete journalize and post the July transactions. Okay. So here we could proceed our next slide. Journalize and post July transaction. And is cleaning service journal. The first one, cash debit, owner's capital credit. So here look, Anwa invested to 20,000. Anwa invested 20,000 cash in the business. For this, just the journal will be cash debit, owner's capital credit. Number one. Second, purchased used truck for 12,000. paying 4,000 cash and the balance on account. This is July 1 transaction. Purchase used truck. We are getting this truck, so truck will be debit. Paying 400 cash, cash will be credit, and balance on accounts. So account payable, credit. So this is the equipment. This is debit, cash, credit, and accounts payable, credit. And next, purchase cleaning supplies. $2,100 on account. So for this transaction, supplies, we are getting supplies. The supplies asset, the asset will be debit, and on account. That means the account payable will be credit. This is supplies debit, account payable credit. And next, paid 1,800 cash on a 1-year insurance policy effective July 1. Paid, already paid, and cash. That's a 1-year insurance policy. So here insurance policy or prepaid insurance will be debit, and cash will be credit. So here insurance policy debit and cash credit. Okay. And then billed customers 4,500 for cleaning service. So we made a service, we served to the customers, and customer didn't pay us. So for this transaction, our account receivable will be debit, and cleaning service will be credit. Here account receivable will be debit, and service revenue will be credit. Okay. And then paid 1,500 cash on amount owed on truck, and 1,400 on amount owed on cleaning supplies. That means paid this amount. So paid, that means cash will be credit, and truck 1,400 and amount owed on cleaning supplies. So for this transaction 18, just look here, accounts payable 2,900. This is our debit balance, debit, and cash credit. Cash credit. Here total 2,900. Accounts payable. That means paid, accounts payable, accounts payable. Here we have accounts payable, 8,000, equipment and supplies accounts payable 2,100. Okay. So according to question, paid 1,500 cash on amount owed on truck. For truck purpose we have paid, and 1,400 on amount owed on cleaning supplies, for cleaning supplies. So here cleaning supplies we purchased. Here purchase used, so paying 400 cash and the balance on account. Okay, so here two matters. Number one, use truck. Truck purpose we have owed taka, cash 4,000, and balance 8,000. From 8,000 now we are paying only 1,500, and 1,400 amount owed on cleaning supplies. So cleaning supplies 2,100 on account. So from this amount now we are paying 1,400. So the journal already we have seen, the cash credit and accounts payable will be debit. Now paid 2,800 cash for employee salary. So for these transactions, paid, that means cash credit, and employee salary, that means salary expense debit. Okay, you can look here, salaries and wages expense debit and cash credit. Okay. And next, collected $3,400 cash from customers billed on July 12. And July 12, just we sell our service on credit. So now the collected this amount. So for this amount our cash will be debit. For this transaction cash will be debit, and account receivable will be credit. Okay, cash debit, here the cash debit, and account receivable credit. And here bill customer 6,000 for cleaning service, just like 12 and this one, that means 20. 5 July 12 and July 25th, the same journal. That means this 6,000 cleaning service billed customers. That means customers have taken services but not yet pay to the company. So for this transaction, account receivable debit and service revenue will be credit 6,000. So please look here, everybody. Account receivable debit and service revenue credit. And then paid 350 for monthly gasoline bill for the truck. For these transactions, gasoline bill paid. So the cash credit and gasoline bill expense debit. So here look, gasoline expense debit and cash credit. And finally withdraw $5,600 cash for personal use. For this withdraw, this is very easy journal. So drawing debit and cash credit. So it's drawing debit and cash credit. So our journal finished. Now post the July transaction, that means ledger. This is all transactions together. That means all journal entries together. Now post the July transaction. This is cash. So according to journal, we have a cash in several date. So here cash July 1, cash July. This is debit. Okay, this is debit. This is debit cash. This is cash credit. Debit 20,000. Credit 4,000. This is cash credit 1,800. Here cash credit. That means cash credit 2,900. Cash credit here 2,800. Here cash debit 3,400. And here also cash credit $350. And here also cash credit 5,600. So debit and credit combination, finally we get a balance here. This is the cash ledger, general ledger, NS cleaning service cash. So owner's capital 20,000 debit, and equipment, prepaid insurance, accounts payable, salaries and wages payable, this is credit. So here please look on this balance. This is debit balance. Now credit, after subtracting we are getting this balance 16,000. 20,000 minus 4,000 16,000 minus 1,800 14,200 minus 2,900. That means $11,300. And then 2,800 we are getting 8,500. Then debit, and it must be added. So total 8,500 and 3,400, it will be $11,900. And this must be subtract, and this would be subtract. So this is the balance of cash. And like account receivable, this is debit and credit and debit. So this is the balance of account receivable. So in our trial balance, when we prepare our trial balance, that means in this is the debit side, this is the credit side. Debit side cash will be also debit side, and account receivable also will be our debit side. And supplies, this is the debit balance, prepaid insurance debit balance, equipment debit balance. In our trial balance, just we will use this balance. That means supplies balance, prepaid insurance balance, equipment balance. I think everybody is clear. Now we proceed our next slide. Accounts payable, please look here. Account payable, this is 7,200 balance. This is our credit balance. That means when we prepare our trial balance, suppose this is our trial balance, this is the credit side. So this balance will be our credit side. Wages payable, salaries and wages payable, this balance would be our credit balance. owner's capital must credit balance. Okay, that means here this is credit, and the balance would be credit. And salaries and wages payable, cash accounts payable. This is wages payable. This balance would be credit balance. Sorry, here 12,000. 12,000. This is credit, not debit. Sorry, and this is credit also. And known as drawing. This is our debit balance in trial balance. In trial balance, when we prepare our trial balance, this balance would be drawing debit balance, service revenue. This is credit balance. This is credit balance, and gasoline expense. This figure, this also debit balance, and salary wages expense. This is our debit balance. So finally, all together our posting, that means ledger, and trial balance. This is trial balance. Please look here. The trial balance items come from our posting, that means ledger. So cash, account receivable, supplies, prepaid insurance, and equipment. This is debit balance. Also drawing debit balance, and two expenses are debit balance. And here the accounts payable, owner's capital, and service revenue, credit balance. And balance set, the both sides are equal. Okay, and now enter the following adjustment. Unbilled and uncollected revenue for service performed on July 31st were 2,700. For this, accounts receivable debit or service revenue credit. Now depreciation on equipment. Depreciation expense debit, accumulated depreciation credit. Now 1/12 of the insurance expense. That means insurance expense debit or prepaid insurance credit. Our inventory count shows 600 on cleaning supplies on hand at July 31st. That means supplies expense debit and supplies credit. And now accrued but unpaid employee salaries were 1,000. So salary and wages expense debit and salary wages payable credit. Okay, this is the adjusting entries, journal entries. Adjusting, that means this is adjusting journal entries. Finally, enter the following adjustment on the worksheet. Complete the worksheet. Now this balance comes from the comes from the trial balance. This is trial balance item. All are trial balance item. This, and this is the adjustments. That means these figures. This 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These 10 figures here. Debit credit 10 figures, and this is the adjustment total figure. Any adjusted trial balance after actually trial balance and adjustments. Just we call it adjusted trial balance. That means cash no adjustment, and this is account receivable debit, account receivable debit. So this is our total debit balance, and this is supplies debit, and this is supplies credit. So this is our supplies debit balance, because after balancing it must be debit balance. And here the prepaid insurance 1,800 debit balance, this is credit balance. So after balancing it could be debit balance after balancing. Okay, so this is the balancing figure. And equipment no adjustment, here no adjustment. Here service revenue, this is credit, and this is also credit. It must be added, these two figures. This is credit figure and credit figure, the two credit figures here, just like this. And this is our total totals. This is our totals. Okay. And income statement, we know that in a previous lecture I told about this matter. Basically income statements and balance sheet from adjusted trial balance, some balance income statements items, some items come from adjusted trial balance, and balance sheet some items come from adjusted trial balance. Okay, so this is the cash, account receivable, supplies, prepaid insurance, equipment, and equipment. So 1, 2, 3, 4, 5 items: cash, account receivable, supplies, prepaid insurance, and equipment. These 5 items, that means actually from here we will take these items. And this is our liabilities items, 2 items, and this drawing 1 item. This is the revenue and all our expenses, and this is our accumulated depreciation. This one payable, this is liabilities. So after balancing we get net income, this figure. This is our net income or net profit. Okay, Now income statements. Actually income statements, this is our revenue, this is revenue, and this is our expenses. 1 2 3 4 5 expenses. So this is 1 2 3 4 5 expenses. Here according to question, so according this income statement, just this is revenue and expense. So revenue is greater than the expense, so it could be net income. Okay, and now net income will added with capital. Income added with capital. So our capital 20,000, you know, this is 20,000 our capital. According to question, this is our capital, this 20,000. Okay, so capital, and then add net income, and then drawing. This is our drawing. According to question, we have drawing this figure 5,600. Okay, so after subtracting this figure, we are getting owner's capital. That means the closing capital. This is capital July 1 and this is capital July 31st. Okay, and we use this figure in our when we prepare the balance sheet, because of, you know, when we prepare the balance sheet, in our balance sheet, just uh, asset liability plus owner's equity. So this figure is our owner's equity or owner's capital. Okay, so balance sheet or financial statements are interrelated. That means the income statement, net profit, we are using in our owner's equity, or owner's equity, from owner's equity the closing capital we are using in the balance sheet. Okay, so actually this is the capital. So we call financial statements are interrelated. So here this is our total asset, current asset, and this is long-term assets, and accumulated depreciation less, and we are getting this figure. This is our total assets and liabilities, these two figures, and this is the owner's capital. So in our balance sheet, to both sides, that means this sides and this sides are equal. Adjusting journal entries, journalize and post adjusting entries. This is our adjusting journal entries: account receivable, service revenue, depreciation expense, insurance expense, supplies, salaries and wages expense, salaries and wages. Okay, already please look here. This is the adjusting entries. Adjusting entries. Okay, this account receivable, service revenue, depreciation expense, insurance, supplies as salary and wages expense, and wages payable. Okay, actually this is the same matter. Analyze and post adjusting entries. This is the adjusting entries, the same matter. Now the analyze and post adjusting entries. So according to question, just you know, service revenue, cash, service revenue, and adjusting entries 2,700. That means this figure, service revenue, here we have 2,700 we use here. Actually our previous journal ledger, you know, this is our ledger. Ledger means posting. Look here, this is account receivable, service revenue, 10,500. This is our service revenue, 10,500. Service revenue 4,500, and cash, sorry, this is account receivable, account receivable, 4,500, cash 3,400 credit, and service revenue again 600, that's 7,100. Adjusting entries now 2,700. So after posting all the transaction, we are getting account receivable this figure. Now just in our previous posting, that means our previous ledger, this is the ledger accounts. In our previous ledgers, now we are adding just this one here, account receivable 2,700, only one figure of account receivable. So this is the 2700. This is our account receivable items, 2700. Okay. So now this it would be our account receivable item. Now supplies the same figure. This is the adjusting entries, adjusting entries, adjusting entries, adjusting entries, adjusting entries. But and now here also adjusting entries, adjusting entries, adjusting. Okay, and closing journal entries. Now we would be closed. So you know that just we need to be closed our revenue, expense, and uh, drawing. So revenue, when we close our revenue, so we know that revenue close to income summary. The revenue will be debit, income summary will be credit, and all expenses close to income summary. So income summary will be debit, and all expense will be credit here. And this figure is greater than this figure. That means this income summary credit balance, and this is income summary debit balance. So after balancing, credit balance will be that means the owner's capital. This is our net income. The balancing figure 6,000, 9,000 our net income. So net income owner's capital. That means income summary close to owner's capital. So owner's capital will be credit and income summary will be debit. Okay. And now drawing. So we know that drawing close to uh, owner's capital. So drawing will be credit and capital will be debit here. So here we know that owner's capital, actually we have owner's capital 20,000. Owner's capital 20,000. This is the basic figure, the fundamental figure, investing figure 20,000. And with 20,000 just 6,900, this is our net income. Addition with this figure, that means we would add this figure, and this is our less figure. That means this is the closing entry 5,600. 5,600, this is our closing figure. That means this figure 5,600 drawing. The drawing must be subtract from this figure. So after subtracting this figure, we are getting this figure. Okay. Now owner's drawing now would be 0, and income summary 0, revenue 0, and expenses 0. Just we use this figure only post closing trial balance. So journalize and post closing entries. So this is our post closing entries: gasoline expense, depreciation expense, insurance expense, salaries and wages expense. And now post closing trial balance. That means after closing the revenue expense drawing, just we will get some permanent accounts. You know that in my previous lecture I told about this matter. That means in our permanent accounts, just we have asset, liabilities, and owner's equity or owner's capital. So this is our asset items. This is our, these are liabilities items, and this one is owner's capital item, and these are asset items. Okay. So totals equal. Okay. So that's all at this moment. Our next lecture on plant assets, natural resources, and intangible assets. I think everybody will join with me. Thank you so much.